throw it back to Dom and see what he has teed up. What do we have, Dom?
All right, Danny emailed this one. Danny's asking, what are the pros and cons of using the builder's mortgage company? I feel like the sales agent is pushing us in that direction.
All right, that is a great question. We hear that often. And yes, they are pushing you to use the builder's in-house lender. And there's a couple reasons they're doing that. One is, honestly, they want control of the deal. They want to know that you're going to close. They don't want to trust a third party's approval. They want to know. That's how all this started, was the builder wanted the certainty that they had the most qualified buyers. So it started with the intent of, innocently enough, they wanted the full peek behind the curtain. They didn't want to have to depend on your bank or an outside mortgage company to know this was a good deal. But don't kid yourself. It's a profit center for the builder. It's part of their business model. They have in-house title services. They have in-house mortgage companies. So I don't know how many of you are old enough to remember. I think it was CarMax used to have the TV commercial, and the guy had the long, skinny balloon in his hand, and it's the same kind of balloon that they would make, little balloon animals out of. And he would squeeze one end and say, okay, a typical dealer will lower the price. And he squeezed that end of the balloon, and the other side of the balloon got really fat. He said, but if you squeeze price, then the interest rate on the loan goes up. Or if you squeeze down on the interest rate side, the price goes up. And he was using that to symbolize that CarMax played no games. Just know that, when the builder comes out and says, hey, we're going to give you $20,000 in upgrades if you use our team. Well, first of all, they're not dollar for dollar giving you 20 grand worth of anything, because if it cost them $5,000 to upgrade the kitchen or to put the cool tile in or the wood floors, whatever you want, they probably have $5,000 and it didn't cost them 20. The sad part is you can't go out there and upgrade your kitchen for $5,000 without it. So I understand the enticement. So to answer your question, the pros are you can usually get some closing cost credits, some upgrade credits, whatever the case may be. The cons are that's the builder's lender. And I'm going to share a story with you, and I'm not going to mention any names because I do not have enough money in my war chest to defend myself against a lawsuit from a national builder, but this just happened to us, our team. We just experienced this last week. We had a builder, in-house mortgage company that denied a transaction 5 days before it was supposed to close. They apologized. The builder offered to give the client their deposit back. Now, they waited 18 months to buy this home. 18 months they've been renting a place on a month-to-month because they didn't know when they were going to close. They didn't want to sign a lease, so they're paying an elevated rent month-to-month for 18 months. They picked out the flooring, the paint colors, the perfect kitchen cabinets. They had a wall moved. This is their dream house. 18 months later, they find out that the in-house mortgage broker says, we can't fund your deal. You're denied. So the builder was gracious enough to give back the deposit, and they resold the house for $125,000 more because it's appreciated over the last 18 months. So in those 5 days that they had this news, the realtor, who we have an amazing relationship with, brought the deal to us, and we tried to salvage it. Here's the thing. We got them approved. We got them approved with a conventional rate. It was no Mickey Mouse stuff. It was a great mortgage program. There were no problems with the deal. There were some sticking points that our team with over 30 years experience were able to navigate around, but it shouldn't have been denied. But here's the thing. We asked the builder for an extension because we need a new appraisal. They would not transfer the appraisal to us. So 5 days wasn't realistic. We needed about, I don't know, I'm going to say 8 or 9, but we were asking for a 15-day extension. So the buyer and the buyer's agent walked away from that feeling manipulated by the builder. Did the builder have the client's, or the builder's mortgage company rather, have the client's best interest in mind when denying that file? Or did they have the builder's best interest in mind when they denied the file and in turn resold the property for, I don't know, what did I say, $120,000, $150,000? I'll have to look at the numbers more because it appreciated. So yes, it makes sense because you often can get closing cost credits. You can get upgrade credits. It's super enticing. And, 9 out of 10 times it works really, really well. And I can't tell you how many times in my career I've just bowed out to the builder's mortgage guy and told my client, listen, go with them, get the kitchen upgrade, get all the great stuff. Let me review the rate pack in mortgage package that after you close. And if we can better it, we'll refinance you. If we can't, you got a great deal. We work with you through the process and just kind of stand by your side. We've bowed out of that because, a $20,000 kitchen upgrade is enticing. But for that 1 out of 10 scenario, as I just mentioned, that person would have been well suited to have their own mortgage team in place from the very beginning. So just keep that in mind. I mean, if you were getting divorced, would you use your wife's divorce attorney? And I'm not saying that, a builder-client relationship is adversarial like a divorce. I'm just saying having your own team who's watching your own backside is super important in some major decisions. At very least, get a second opinion on the mortgage and maybe get an approval. We'll do it for you. I'm happy to help. We'll give you an approval and take it back to the builder and see if they can match it. If they can match it, fantastic. Then you've got a great deal. If they won't match it, then go with your own. Go with us. I'm happy to do it. As a matter of fact, now that I say that out loud, that sounds like an awesome strategy. If you're considering using the in-house mortgage team, go with the Mr. Mortgage team. No, with anybody. We'd love it to be us, but with anybody that you have confidence in, get your own pre-approval, take it to the in-house company and see if they'll match it, and then see if they'll give you an extended rate lock or a rate lock guarantee, because that's the other side of the coin, is what happens when the rate lock expires and you have to buy an extension. And if it was the builder's fault and not your fault as the client, who's paying for that extension? So if you have questions around that, give us a shout, 561-291-8569. That's 561-291-8569. At very least, I'll give you some great questions to ask the builder's lender, so you'll know you're getting a great deal. So anyway, I hear that siren. Maybe that's the builder's lender coming up behind me with a big stick. But no, give us a call. I'll walk you through and answer any questions you have. So 561-291-8569 is the Anytime hotline. 561-291-8569, or as always, www.mr.mortgage. That's mr.mortgage, never ever a .com. Mr.mortgage. Thanks. Hey, it's mark-eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com. www.reallyGreatAgents.com.
Here's another 5-star review.
We started our loan with a different company. They said we were approved, but at the last minute they told us there was a problem. I still don't know what went wrong, but thankfully our real estate agent told us about Mark. I was pretty stressed, but it's the perfect house, so we gave Mark a shot. He got it done. I'm not sure what was different, but I don't really care. We even got a better interest rate and with less money out of pocket than the first guy quoted us. It was a great surprise. Yes, I'm happy to recommend Mark and his Mr. Mortgage team.
It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at SOFLappraisal.com. That's SOFLappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. SOFLappraisal.com. And tell him you heard this on the Mr. Mortgage Show.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, we are back, and I just looked out the window of the studio, and I see a parade of builders, mortgage companies with burning torches marching around the building waiting for me. Guys, I wasn't talking badly about you, I swear. No, anyway, I hope that answered that question. You certainly should have, at very least, a second opinion so you know you're getting a great deal. Make sure that upgrade package is really, really worth it. So anyway, I hope that helped. We try to do all this, give you the best information that we have to help you make better mortgage and real estate decisions. This is important for you guys. It certainly is the largest financial commitment that most of us ever make in our lives. And I was blessed at an early age to make mine with some very good advice from somebody who, they just kind of pushed me off the ledge and said, you're old enough, you're paying rent, you should be paying a mortgage. And it made a significant difference for me. So building equity, and it introduced me to this side of the business. So super excited to be here. But anyway, my name is mark-eitel. This is the Mr. Mortgage Show, where we answer your mortgage and real estate questions and try to do it with a little twist of fun. So speaking of questions, I'm going to throw it to Dom and see what we have.
Brandy just called. Brandy asked, I have lots of equity and want to use some of it to buy a couple investment properties. How do you recommend I do this?
Hey, Brandy, before I answer that question, I have to ask you, does anyone sing that song back to you, that Brandy song from the 70s? I wanted so badly to sing that, but there's a reason I play the drums in my band and don't sing, because this is the only time I should be allowed to have a microphone. And there's several people that would argue that even now I don't deserve one. So anyway, Brandy, good question. There are a lot of opportunities in the market to own rental properties. Now, if you're going to buy flips, there's different strategies around that, and I'm happy to help. But I'm going to use your question to talk about some strategies that we're seeing people execute to buy rental properties, because as we all know, rent prices are going crazy. I mean, there's really no slowing in sight, and it seems to be supporting the housing prices because, if you can rent or own and the price is about the same, you might as well own. So anyway, if you're buying rental properties, here's something to consider. To take the money out of the property, I'm assuming that you don't want to refinance your first mortgage. You may have gotten a great rate. And if that's not the case, then doing a cash out refi might be the answer. But let's talk to the people out there who are considering doing what you're doing, yet they've already refinanced in the last 2 years and they're sitting at that historic low rate that I mentioned in the opening segment of 2.68% for a 30-year fixed rate, which is crazy. If you got it, congratulations. That's amazing. So if you're one of those people with a ridiculously low rate, but you want to pull some of this equity out to capitalize on other opportunities, there's a couple of ways to do it. One is a home equity line of credit, a HELOC. A home equity line of credit is exactly as it sounds. It's a line of credit collateralized by the equity in your home. Here's the cool part about it is there's very rarely any costs associated with it. So you can get it for, relatively no upfront expenses. It's a low interest rate to start with. It's interest only, usually interest only, for a period of 10 years. And then if after 10 years, they take your balance and convert it to either a 10 or 20-year loan. So for 10 years, you have access to this credit line. Here's the downside with an equity line. And I'm speaking to anybody in the audience who's old enough to remember the crash, which wasn't that long ago. An equity line can be closed against your will or reduced against your will. So let's say you've got a $100,000 equity line that you never use. And let's say some of these fear-mongering headline writers are correct and we are going into a crash and values pull back. Well, if your value pulls back and you don't have enough equity to support that underwriting risk for that equity line, they may say, hey, Brandy, you're a fine girl. What a good wife you would be. See, I had to work that in there. But they may say, hey, Brandy, you have a $100,000 equity line, but that was based on a property value of $400,000. Now your property's worth $360,000. We're going to back that down to $60,000, whatever the case may be. So they have control over it. And if there's zero owed on it, they can close it out altogether. I can give you a list of, dozens and dozens of people I know that happened to in the early 2000s. The other way to access it, which is probably the easier way from the standpoint of pull the funds out, use them, and never have to look back, is a home equity loan. And that's usually a 15 or 20 year term. It's all, there's different banks, different products. We have a home equity loan that we offer. But what it is actually it becomes a second mortgage. It's a loan against your equity. It's at a fixed rate for a fixed period of time. It can't be reduced because it's just like any other mortgage, it's a loan. Then you can take that money and go out and buy your investment properties. And as you hear me talk about all the time, there's a cool new loan product called a DSCR loan where the lender, in this case me, we don't have to look at your personal income. if the property pencils, meaning the rent will cover the debt, then it's fundable. You can get a loan against it.